For most of American history, the relationship between government and banking has been uneasy, often hostile, and frequently destructive. Today it feels ordinary for public money to flow through private banks, to be lent out, leveraged, and occasionally rescued when things go wrong. That arrangement feels permanent, almost natural. But in the middle of the 19th century, the United States made a radical choice. It attempted to cut the financial cord completely, separating the federal government from private banks and insisting that public money be held by the government itself, in hard metal, under lock and key. That experiment became known as the independent Treasury system, and for decades it shaped how the nation handled its finances before quietly disappearing from memory. The roots of this idea lie in a crisis that came before it. In the 1830s, President Andrew Jackson launched a political war against the Second Bank of the United States. He believed the institution concentrated too much power in too few hands and used public funds to influence politics. When the bank's charter expired in 1836, Jackson ensured it was not renewed. But removing the central bank did not end the government's reliance on private finance. Federal deposits were shifted into selected state banks, institutions that soon became flooded with government gold and silver. Those banks expanded credit aggressively, printing paper claims far beyond their reserves and feeding a speculative boom in land and commodities. When that boom collapsed during the Panic of 1837, the weakness of the system became obvious. Banks failed or suspended payments, and the federal government suddenly found its own money inaccessible. The Treasury was solvent on paper, but paralyzed in practice, unable to pay its bills because its funds were trapped inside broken institutions. President Martin Van Buren and his allies concluded that the experiment of trusting public money to private banks had failed. If the government depended on the health of bankers to function, then every financial panic threatened the state itself. The solution they proposed was stark in its simplicity. The federal government would hold its own money, just as a household might keep cash in a strongbox. Taxes, tariffs, and land sales would be paid in gold or silver coin, not banknotes. That coin would be stored in government-run vaults located in major commercial cities. When the government needed to spend, it would pay directly from those reserves. Banks would neither hold federal deposits nor profit from them. In effect, the Treasury would become its own custodian, isolated from the credit system entirely. After years of political fighting, this idea became law in 1846, signed by President James K. Polk. The Independent Treasury Act marked one of the most radical departures from modern finance ever attempted by the United States. Across the country, imposing sub-treasury buildings were constructed, designed less like offices and more like fortresses. Thick stone walls, iron doors, and underground vaults symbolized a philosophy that treated money as a physical object to be guarded, not an abstract flow to be managed. For a time, the system appeared to work. Government finances became stable and predictable. When war broke out with Mexico in the late 1840s, the Treasury could fund military operations without borrowing from bankers, because it already held the necessary gold. The California gold rush soon added even more metal to circulation, strengthening the hard money foundation of the system. Supporters argued they had proven a nation could function without a central bank and without entangling public finances in private speculation. Yet the strengths of the independent Treasury concealed a serious weakness. By design, the system ignored the needs of the broader economy. When trade expanded and imports surged, gold flowed into Treasury vaults through tariff payments, removing money from circulation at the very moment businesses needed more liquidity. During downturns, when trade slowed and private demand for cash collapsed, the Treasury spent its reserves, injecting money when the economy was already contracting. Instead of stabilizing conditions, the system amplified them. This rigidity became painfully clear during the Panic of 1857, as banks across the country struggled, and credit evaporated. Millions of dollars in gold sat idle inside government vaults, legally untouchable. Merchants and manufacturers demanded relief, but the law forbade the Treasury from acting as a lender, or even depositing funds into banks. Officials watched a financial crisis unfold, while sitting atop a hoard of metal that could have eased the panic. Emergency measures eventually pushed some money back into circulation, but the episode exposed the limits of a system that prized purity over flexibility. The Civil War delivered the decisive blow. Fighting a modern industrial war required resources on a scale the independent Treasury had never been designed to handle. Gold reserves were insufficient, and confidence in banks deteriorated as the conflict worsened. In 1862, necessity forced the government to abandon strict hard money and issue paper currency, the greenbacks. Although the independent Treasury structures remained, the original vision of a purely metallic, bank-free system was gone. The Treasury had become an active participant in managing credit and currency, even if the law had not yet fully caught up. In the decades that followed, the system lingered in an uneasy half-life. Treasury officials began quietly intervening in markets, depositing funds into selected banks during seasonal shortages and withdrawing them during booms. Without a clear mandate or modern tools, the Treasury Secretary became a de facto central banker, relying on personal judgment rather than institutional rules. Each autumn, as crops moved and demand for cash surged, the entire economy waited to see whether Washington would act quickly enough to prevent disruption. That improvised arrangement collapsed during the Panic of 1907. The crisis overwhelmed the Treasury's limited capabilities, forcing private financiers to organize rescues on their own. The spectacle of the world's leading industrial nation depending on one banker to stabilize its economy was deeply embarrassing. It convinced policymakers that the old system was obsolete. The independent Treasury had protected government funds, but it had failed to protect the economy itself. This realization paved the way for the Federal Reserve Act of 1913. The new central bank was designed to do exactly what the independent Treasury could not: hold reserves, issue currency, and provide liquidity during panics. For a few years, both systems coexisted awkwardly, but by 1920 the sub-treasury system was formally abolished. Its vaults were emptied, its clerks reassigned, and its philosophy quietly set aside. Today, the physical remnants of that experiment still stand. Buildings that once guarded the nation's gold now serve as museums and monuments. They reflect a time when financial security meant stone walls and iron doors, not balance sheets and digital ledgers. While the independent Treasury ultimately failed, the ideas behind it never fully disappeared. Periodic calls for full reserve banking, distrust of fractional lending, and interest in financial self-custody echo the same impulse that drove reformers in the 1840s. The lesson of the independent Treasury is not simple. It showed that separating public money from private risk can protect the state. But it also demonstrated the danger of inflexibility in a complex economy. By choosing the Federal Reserve, the United States traded absolute safety for adaptability, accepting inflation and moral hazard in exchange for stability during crises. That trade-off remains unresolved. As new debates emerge over digital currencies and the future of banking, the forgotten experiment of the independent Treasury reminds us that the question of who controls money, and how rigidly, has never truly been settled.